A high-dividend ETF can pay you regularly and still leave you poorer. That is the first incision we make on income autopsy, not how big is the check, but what happened to the money that stayed inside the fund. Today's patient avoids that ugly diagnosis. Its payout has held steady, its underlying value has grown, and its distribution-inclusive return is meaningfully stronger than the price chart alone suggests. But there is still a machine under the hood, and before anyone calls it healthy, we need to see exactly what that machine owns, how it produces cash, and what investors surrender in exchange. Today we're dissecting the iShares Core High Dividend ETF, ticker HDV, using data through July 17, 2026. HDV is built around the Morningstar Dividend Yield Focus Index. In plain English, it starts with high-yielding U.S. companies, screens them for earnings strength and dividend sustainability, and then weights the resulting portfolio by dividend characteristics. The index contains 75 equities, so this is not a one-company income bet. It is a rules-based basket designed to favor established businesses capable of supporting their dividends. That distinction matters. A stock can have a high yield because it reliably produces cash, or because its price has collapsed while the dividend waits nervously beside an open trapdoor. HDV's screening process is intended to separate durable income from distress wearing a cheap tuxedo. The fund is also described in the supplied strategy data as having an options income component. That means we have two layers to examine: the dividend-paying equity portfolio and the trading activity intended to turn some market movement into additional cash. One layer supplies corporate dividends. The other can harvest option premium, with trade-offs we will open up later. HDV belongs to the large value category. Think mature cash-generating companies rather than a portfolio built primarily around speculative growth. The basic proposition is straightforward. Own a diversified group of higher-yielding U.S. businesses, collect income from the portfolio, and distribute cash to shareholders. The important question is whether that cash has arrived while the investment itself remained healthy. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold HDV or any other security. ETFs can lose value, their distributions can change, and historical results do not guarantee future performance. Verify the current prospectus, holdings, distribution notices, tax documents, and other official fund materials for yourself, and consult a qualified professional who understands your circumstances before making a decision. Let's check the vitals. HDV launched on March 29, 2011. It pays quarterly, so investors should expect a more traditional income schedule rather than a monthly deposit arriving with the regularity of a utility bill. Assets under management stand at $13,570 million. That is a substantial pool of capital, which tells us this is an established product rather than a tiny experimental fund trying to find an audience. The expense ratio is 0.8%. For every investor evaluating an income fund, cost matters because fees come out of the same economic engine expected to support both the portfolio and the payout. A low expense burden does not guarantee good results, but it gives the underlying assets less drag to overcome. The fund's equity classification also tells us where the real risk lies. This is not a savings account disguised as a ticker symbol. It owns companies, so its value can fall when stocks decline, when a major sector weakens, or when investors rotate away from mature dividend payers. Its distribution schedule may feel orderly while the market price behaves like an equity investment, because that is exactly what it is. The large asset base, long operating history, broad index, and low stated fee all earn favorable marks. None of them removes market risk, but together they make HDV look more like a durable portfolio tool than a financial novelty held together with marketing tape. The headline distribution yield is 3%. That is the figure most likely to catch an income investor's eye, but it needs context before it earns a place in anyone's plan. The latest distribution was 9 cents per share. If someone mechanically annualizes only that payment, the resulting rate is 1%. That gap is a useful warning against treating one quarterly check as though it were a permanent contract. A single payment can be unusually low or high. It can reflect the timing of dividends received by the portfolio, changes among the underlying companies, or other fund-level decisions. The sensible question is not merely, what did the last check look like? It is, what pattern has the fund established and what supported those payments? A yield displayed on a website is a measurement based on a particular method and period. It is not a coupon promised by the fund. This is especially important for investors trying to match portfolio income with living expenses. A quarterly payer can produce uneven cash flow even when the longer-term distribution pattern is sound. Someone budgeting from the headline figure without checking the actual payment history could confuse an annualized estimate with money already earned. HDV's income level is not trying to impersonate a lottery ticket. That is a positive feature for the assigned diagnosis. The payout sits within a range that can be evaluated alongside the health of the underlying portfolio, rather than demanding that the fund perform financial acrobatics merely to keep an enormous advertised rate alive. Time for the history. The average of the first 4 distributions was 16 cents per share. The latest 4 averaged 17 cents. In the deterministic comparison supplied with the data, that later average equals 110% of the launch period average, so the trend is classified as up. That does not mean every individual payment rose in a smooth staircase. The latest check itself demonstrates why investors should not judge a quarterly fund by one isolated deposit. Distribution histories often look more like a hiking trail than an escalator. The direction over a meaningful stretch matters more than one dip between 2 markers. The encouraging part is that the recent group of payments is not lower than the opening group. HDV has operated since 2011 through different interest rate environments, market sell-offs, commodity cycles, and changing investor preferences. The data provided here does not break down every event or payment, so we should not invent a neat story for each quarter. What we can say is that the launch period and recent averages do not show a payout machine steadily shrinking into irrelevance. For an income investor, steadiness can be more valuable than spectacle. A fund that advertises an eye-popping rate and then repeatedly cuts its payment forces shareholders to rebuild their budgets around a moving target. Here, the longer comparison supports a much calmer conclusion. The payout record has held its ground and improved modestly across the periods supplied. The next question is whether those distributions were funded while preserving the investment base. A stable check can still be deceptive if the fund quietly hands investors pieces of their own capital. That brings us to the body part. High-yield marketing sometimes leaves outside the camera frame. The latest price and net asset value figure is $28.25. The launch reference price was $19.02, and the NAV return since inception is 49%. That is central to this autopsy. The portfolio did not merely send cash out the door while its remaining value collapsed. Its underlying per-share value finished above the launch reference and produced a positive price-only result over the supplied period. The maximum drawdown was negative 17%. That is the reminder that healthy does not mean motionless. At its worst measured decline, an investor watching the account would have seen a meaningful paper loss. Anyone who cannot tolerate an equity drawdown should not let the word dividend create a false sense of protection. Imagine 2 shareholders holding the same fund during a sharp decline. One sees the distributions as compensation for patiently owning productive businesses and leaves the portfolio alone. The other needs to sell shares to meet an unexpected expense. The first investor can wait for the assets to recover. The second turns a temporary market wound into a permanent reduction in ownership. Income funds still require liquidity planning because distributions do not cancel sequence risk. NAV is also where strategy quality eventually leaves fingerprints. If a fund continually promises more cash than its assets can economically support, the damage tends to appear in a deteriorating per-share value. HDV's path based on the figures provided does not show that pattern. There was volatility and a real drawdown, but the long-run direction remained positive. Cash distributions since launch total $3.93 per share, when those payments are included. The simple distribution inclusive return since inception is 69%. That is the number that puts the whole case in focus. A price chart measures what remained invested. An income-inclusive result recognizes that shareholders also received cash along the way. Ignoring either side produces an incomplete diagnosis. This distinction is especially relevant when comparing HDV with a plain growth-oriented position. A growth portfolio may retain more of its economic return inside rising share prices. An income portfolio deliberately sends part of the result to shareholders. Comparing only their charts is like judging 2 restaurants by the cash left in their registers after one already paid its staff. You have to account for where the money went. The supplied total return figure holds up because the distributions added to an already positive underlying result. That is different from a fund using a large payout to distract from severe capital destruction. Here, the cash and the remaining asset value worked in the same direction over the full period. There is still an investor-specific decision hiding inside that success. Someone who spends every distribution ends with a different compounding experience from someone who reinvests it. The provided figure is a simple distribution-inclusive measure, not a personalized account statement with reinvestment dates, taxes, or trading costs. It is best used as a broad measure of whether the fund created value through both channels, not as a promise of what any individual investor earned. Now we open the machine. The portfolio tracks the Morningstar Dividend Yield Focus Index. Its leading positions are ExxonMobil Holdings Corporation, ticker XOM at 8%, ABVI Inc., ticker ABV at 6%, Chevron Corporation, ticker CVX at 6%, Verizon Communications Inc., ticker VZ at 5%, the Procter & Gamble Company, ticker PG at 5%, and the Home Depot Inc., ticker HD at 5%. That lineup shows the character of the basket. energy, healthcare, telecommunications, consumer products, and home improvement all appear near the top. These are operating businesses whose dividends provide the portfolio's first source of cash. Because the index is dividend-weighted and screened, the fund is not simply buying whichever stocks display the loudest yield. It is applying rules intended to consider both earnings potential and dividend sustainability. Concentration still matters. Two major energy companies sit prominently in the portfolio, so changes in commodity economics can affect more than one leading position at once. A sector that contributes attractive cash flow can also introduce cyclicality. Meanwhile, a large pharmaceutical company faces its own business risks. A telecommunications company depends on a capital-intensive network, and consumer-facing businesses respond differently to inflation and household demand. Diversification spreads the risk, but it does not turn those businesses into identical income machines. The supplied mechanics also identify an options income strategy. In general, an options income fund generates additional cash by selling option rights linked to assets it owns or trades around. The buyer pays premium today. In exchange, the fund accepts an obligation defined by the contract. A common version is a covered call. Suppose the basket rises sharply after the fund has sold calls against part of its exposure. The option premium remains income, but some gains above the contract's strike price may go to the option buyer. The fund has effectively sold a slice of tomorrow's possible upside to collect cash today. If the market moves sideways, that trade can be useful. From here, investors should watch 5 things. First, read each new distribution notice instead of relying on a static yield displayed by a brokerage. Track the actual payment and its character. Second, compare rolling groups of payments rather than reacting to one quarter. The current history demonstrates why a single check can send the wrong signal. Third, monitor the fund's per share NAV over full market cycles. Temporary declines are normal for equities. A persistent downward staircase would be a different diagnosis. Fourth, check current holdings and sector weights. A rules-based index can change as companies pass or fail its screens, and today's portfolio is not guaranteed to remain tomorrow's portfolio. Fifth, inspect the latest official strategy documents for the option program's coverage, contract terms, and implementation. Those details determine how aggressively the fund exchanges upside for present income. Also compare HDV with the job you actually need performed. If the goal is maximum long-term growth, an income-focused strategy may be solving the wrong problem. If the goal is a diversified stream of quarterly cash with continued equity participation, the design is much more relevant. Suitability begins with purpose, not with sorting a fund screener from highest yield to lowest. Clean bill of health. HDV earns that assigned verdict because the evidence shows 2 functioning systems rather than one disguising the failure of the other. The portfolio produced positive underlying growth, and the distributions lifted the since launch result further. Recent payouts also compare favorably with the opening period instead of tracing a long retreat. This fund appears best suited to an investor who wants established U.S. dividend companies, accepts normal stock market drawdowns, prefers quarterly income, and understands that an options layer can trade away some upside for cash. The low stated expense burden and substantial scale strengthen the case. It is not a guaranteed paycheck, a bond substitute, or a shortcut around market risk. But it also is not a payout illusion collapsing behind a glamorous yield. Based strictly on the supplied figures, HDV has paid shareholders without sacrificing the health of the patient. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF Autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.